In this returning staff training for Unit 1, we will very quickly revisit some conceptual tax topics with the understanding that you already have a foundation in these topics, and so we'll turn our focus to the more exceptional aspects of those topics. Then we'll view these topics from an operational lens, reminding you how to interact with each of these in the tax software. Now, for a comprehensive look at how to enter everything into the tax software, please consult the most updated version of the summary chart, which will give you detailed notes about some of the more complicated details of these entries, as well as just some of the basic entries in the tax software. I also recommend consulting the electronic version of the PUB 4012 whenever necessary. And then we've also provided you the link to the core training webpage that contains all of the resources that are currently available to all of our core members, so you might find those useful. And then we'll go through a tax layer exercise just to practice these tax layer entries and to refamiliarize ourselves with how to enter these topics into the tax software. So here is our training outline. We'll start off with the 1040 overview, and then we'll move to exemptions, followed by filing status, filing basics, and income. Of course, since you already have great familiarity with these topics, we will be focusing again on the more unusual scenarios within some of these topics. And then we'll move on to the standard deduction, non-refundable credits, refundable credits, refund and amount of tax owed, and the state return. So we'll be following the flow of the 1040 in all of these unit summary videos, and we're going to be going line by line of the 1040. Due to the pace and the lack of detail in this training video, I recommend if you would like to revisit a particular topic in more detail to go to the core training website you see here. Here you'll have all the resources linked under the Save First binder. And then after that you have the independent study training outline. So if you click the drop down for Unit 1, you will see all of the video lectures linked by topic. So feel free to go back and watch those videos since they're in much more detail. So let's start off with a revisit to our Form 1040 overview. So we start out with earned income plus unearned income gets us our total income. And from there, we make adjustments, take deductions, and subtract exemptions, and that leaves us with our taxable income. From there, we multiply our taxable income by the tax rate, and that gets us our tax liability. Then we subtract out our tax credits, and that leaves us with our amount owed or refunded. So that's just a high-level overview. Let's move on to exemptions. So for personal exemptions, each personal exemption will decrease taxable income by $4,050. So that amount will actually not change from 2016 to 2017. It remains the same for both personal and dependency exemptions. Taxpayers can claim exemptions for themselves unless they can be claimed as a dependent by someone else. And they can claim a personal exemption for their spouse unless their spouse can be claimed as a dependent by someone else. So remember, it's not whether the taxpayer is claimed as a dependent, but whether the taxpayer can be claimed as a dependent that determines whether the taxpayer can claim a personal exemption. Now let's look at dependency exemptions. So each dependency exemption also decreases taxable income by $4,050. And a taxpayer can claim exemptions for qualifying children or qualifying relatives. And these are individuals who generally live in the taxpayer's home and receive significant support from the taxpayer. So let's consult our Pub 4012, in particular the Exemptions tab in Table 1, to determine dependency exemptions. So right now I'd recommend you go ahead and pause the video and read through Table 1 and Table 2 on your own. We're only going to be focusing on a few of the steps from both of these tables. So let's first talk about a qualifying child. And I want to point out step 4 on page C5, which is the citizenship test. So the question asks, was the person a U.S. citizen, U.S. resident alien, U.S. national, or a resident of Canada or Mexico? I want to point out that taxpayers and dependents who are not U.S. citizens but who lived in the U.S. all year and have I-10 cards, they will most likely be considered resident aliens for tax purposes. And so we can see our Pub 4011 for more details on this. And obviously there are some tests that we need to go through to determine if someone is considered a resident alien. But in general, be aware that if someone has lived in the U.S. all year and has an I-10 card, they're likely going to be considered a resident alien and thus pass step 4 on page C5. Let's also refresh ourselves on the definition of temporary absences. So remember, when we're considering whether or not a child has lived with the taxpayer, we need to consider that they're going to be defined as temporarily absent if they were gone due to illness, education, business, vacation, military service, or detention in a juvenile facility. Let's talk about the support test for a qualifying child. So if we're looking at page C5 and we go to step 8, step 8 asks, did the person provide more than half of his or her own support for the year? And so the person here refers not to the taxpayer, but the potential dependent. So in the question, did that potential dependent provide more than half of his or her own support for the year? Now let's talk about if a qualifying child is a qualifying child of more than one person. So sometimes a child will meet all the tests to be claimed by more than one taxpayer. For instance, if there's a mother and a grandmother that can both claim the same child. In that case, parenthood and AGI are taken into consideration. And this is how we'll determine who's eligible to claim the child. So if the child meets all the tests for 2 people, we're going to consult page C4, and it will give us more instruction about who can actually claim the child. Then what if a child has parents who live apart? In that case, the custodial parent will generally claim the dependency exemption for his or her child. The non-custodial parent, however, can claim the exemption if the parents have signed an agreement. So this will be the Form 8332. It's required for post-2008 divorces. There are also some other divorce agreements that are allowable if it's pre-2008. So this form actually has to be filed with the non-custodial parent's return if that non-custodial parent is claiming the dependency exemption. And the custodial parent will fill out and sign the 8332, and then the non-custodial parent will actually file it. And in terms of dividing the benefits, the custodial parent will have the right to file as head of household if they meet all the requirements. They'll have the right to claim EIC for the child and to claim the Child Independent Care Expenses Credit. And then the non-custodial parent will be allowed to claim the dependency exemption and the child and additional child tax credit. Now let's talk about qualifying relatives. So when we look at page C6, we're looking at all the tests for a qualifying relative. And step 1 asks, is the person your qualifying child or the qualifying child of any other taxpayer? So essentially what that's asking is whether the person is a qualifying child, as we just determined on page C5, so the previous page. Then let's look at step 2. So this is the relationship test, and it asks, was the person any of these relationships to you, the taxpayer? So the relatives that are in step 2 are considered relatives who do not have to live with you. And just as a note, any of these relationships that were established by marriage are not ended by death or divorce. Now, if we get to step 3, then we're asking, was the person any other person who lived with you all year as a member of your household? Well, this person obviously didn't meet any of the relationships in step 2, so any person who's not one of those relationships in step 2 must live with the taxpayer for all 12 months of the year, with a few exceptions. So the exceptions are for kidnapped children, a child who is born or died during the year, and then certain temporary absences such as school, vacation, etc. So if the person does not meet the relationship test in step 2, then they have to have lived with the taxpayer all 12 months out of the year. Now let's look at step 5. This is the support test for qualifying relatives. And it asks, did you provide more than half of the person's total support for the year? And this is asking, did the taxpayer provide more than half of the person's support? So notice that this is different from the support test for qualifying child. Now let's look at a quick example. Roderick, age 29, lives with his uncle. Last year, he worked part-time and earned $2,100. His uncle provided for the rest of his support, including rent and household costs. Can his uncle claim Roderick as a dependent? Can Roderick claim a personal exemption? So we know when we're looking at the qualifying child tests that Roderick is not under 19, he's not under 24 and a full-time student, and he's not totally and permanently disabled. So he's not going to be a qualifying child. So we're going to move on to the qualifying relative tests. And it turns out that yes, his uncle can claim Roderick as a qualifying relative. And that's because Roderick meets all the tests for qualifying relative, which also implies that Roderick cannot claim a personal exemption because he can be claimed as one type of dependent. Now let's talk about filing status. So remember, there are 2 kinds of head of household. The first scenario we're going to talk about are for married taxpayers. To be head of household, married taxpayers must be considered unmarried. And we'll talk about that in just a second. They have to file a separate return from the spouse, maintain more than half the cost of keeping up the home, and then the home has to be the main home for a dependent child, stepchild, or foster child for more than half the year. So those are 3 very specific relationships that qualify. And note, a grandchild does not meet this test. and then the taxpayer has to claim an exemption for the child. So those three relationships are highlighted in red because those are the only three relationships that can qualify a married taxpayer for head of household. Now, as you know, considered unmarried means a legally married taxpayer can be considered unmarried if he or she has not lived with their spouse at any time during the last 6 months of the tax year. Now, the second scenario for head of household is for single taxpayers. They have to maintain more than half the cost of keeping up a home, and then a qualifying person has to have lived with the taxpayer for more than half of the year. So let's talk about who is considered a qualifying person for head of household. The qualifying person for head of household will be determined on page B3 of the filing status tab of the Pub 4012. Let's go ahead and take a look at that, and we'll notice on the far left column it's broken down based on different categories of dependency. So we can see there's a section for a qualifying child, and then 2 sections for qualifying relative, 1 section that's qualifying relative who is your father or mother, and then another section that is qualifying relative other than your father or mother. So the requirements will depend on which category of dependency the person falls into. So just be sure to follow the chart carefully to see those requirements. Now let's talk about qualifying widow or widower with dependent child. A taxpayer will file with this filing status if his or her spouse died recently and the taxpayer did not remarry, and the taxpayer has a dependent child, specifically a son, daughter, stepson, or stepdaughter, and the taxpayer provides over half the cost to maintain the main home for themselves and the child. So again, this filing status requires very particular relationships to the taxpayer. So if the taxpayer is unmarried and widowed, if the spouse died during the current tax year, then the taxpayer can file as married filing jointly. If the spouse died during one of the 2 preceding tax years and the taxpayer has a qualifying child, then they can file as qualifying widow or widower. And if the spouse died 3 or more years before the current tax year, the taxpayer can file as single or head of household. Well, let's go through a quick exercise. Ben and Ashley were happily married since 1965. They had no children, but Brian's brother, who they claim an exemption for, lived with them for the last 10 years. Ashley passed away 2 years ago. Even after her death, Brian continued to maintain the entire cost for the home, and his brother still lived there. What is Brian's filing status? So, since Ashley passed away 2 years ago, Brian is still in that window for qualifying widower, but because of the relationship that his dependent has to him, being his brother, that is not one of the relationships that can qualify Brian as a qualifying widower with dependent child. So, because of that, Brian's filing status is going to be head of household. And again, this is because his brother is not his actual child, even though his brother is a dependent. So let's take a closer look at the decision tree within the Pub 4012. And let's go through a few scenarios. So we'll go to the top left corner where it says start, and we'll ask, were you married on the last day of the year? If yes, we're going to go all the way over to the right and ask, did you or your spouse live apart all of the last 6 months of the year? So if someone answers yes to that question, then they are considered unmarried and can potentially file as head of household if they meet all of the following requirements underneath. So you'll see, as it's highlighted and with a red box on the far right, that a married head of household taxpayer has to have a child, stepchild, or foster child who lives with them for more than half the year. So, those three particular relationships. Now, let's do a different scenario. So, let's go back to the top left corner and ask, were you married on the last day of the year? And assume the taxpayer says no. And so, in that case, we ask, did your spouse die during the year? And let's assume that they say no again, but that their spouse did die in the previous 2 years. Then we're going to ask, did your dependent child or stepchild live in your home all year? And so, again, for qualifying widow or widower with dependent child, it has to be a child or a stepchild. Now, let's stay on the left-hand side of the screen, but assume that this next person is single. So they never had a spouse, and their spouse didn't die in the preceding year, so they get all the way to the bottom left. So they're single, and we're asking them, did you pay more than half the cost of keeping up the home for the year? And did a qualifying person, as defined on page B3, live with you in your home for more than half of the year? So this is the one where we're going to turn to page B3, and we would see if the person who lives with them is either a qualifying child or qualifying relative, and then proceed through the chart to see if they meet all the requirements to be considered a qualified person. So just notice with these red boxes the differences in all of the relationship requirements based on the taxpayer's filing status. All right, now let's talk about filing basics. In particular, who must file. So we're going to decide whether someone must file a tax return. And to do that, we'll need to know the individual's age, their gross income, and that's going to be defined as all the income received during the year in the form of money, goods, property, and services not exempt from tax. And that can include both earned and unearned income. And note here, we're not going to include Social Security in this figure unless two conditions apply, and you can see the Pub 4012 for more details. But as a reminder, be sure to read all of the footnotes in the Pub 4012 when you're deciding whether or not someone needs to file a tax return. And then it's also going to be based on an individual's filing status. So we have to use the Pub 4012 to determine if someone is legally required to file a return. And Chart A is going to be for most people. Chart B is for children and other dependents. Chart C includes unique situations when someone must file even if their gross income is not over the threshold. And then Chart D, who should file. So who do we recommend should file because they're going to get a refund? So for children and other dependents, we're going to refer to Chart B. If a parent can claim a child as a dependent, the dependent may still need to file a return. As y'all remember, this is a huge common misconception among our taxpayers. They normally think that just because they're claiming their child as a dependent, that their child's part-time job and the money they're earning doesn't require them to file a tax return. And we know that's definitely not the case. So, in one instance, a dependent who's under 65 and not blind will need to file a return if their earned income is greater than $6,300. And then Chart B will also break down scenarios for unearned income as well and different demographics of dependents. Now, there are other situations when you must file, and these include if the taxpayer owes special taxes, if they received health savings accounts distributions, if they had net self-employment earnings of at least $400. And so by net self-employment earnings, we mean profit minus expenses to get net earnings. If they received an advance premium tax credit to pay for health insurance. So now, who should file? A taxpayer should file if they had income tax withheld from their pay, if they made estimated tax payments, and then they should also file if they qualify for refundable credits, such as the Earned Income Credit, the Additional Child Tax Credit, and the refundable portion of the American Opportunity Credit. So let's go ahead and jump into our income section now. And let's review what is considered non-taxable income. So most commonly misunderstood is SSI, which is Supplemental Security Income. And people often confuse this for Social Security benefits. Now, it is administered by the Social Security Administration, but SSI is non-taxable. Child support is also non-taxable, and people tend to confuse that with their alimony payments. So let's go to line 7 of the 1040. Of course, we have our W-2 for wages. In box 1, we have our wages. In box 2, we have federal income tax withheld. And then boxes 3 through 7 are our FICA taxes, and box 8 is for allocated tips. Box 10, we have dependent care benefits. So this is if an employer is providing dependent care. Box 12 is for unique codes. Box 13 is for certain check boxes. And then box 14 is for our non-standard codes. Down towards the bottom, we have boxes 16 and 17 for state wages and state withholding. And then boxes 18 through 20 for local wages and local withholding. So let's talk about FICA taxes. These are going to auto-populate in TaxSlayer. So we want to review and correct as necessary, being very careful to copy exactly what we see on the taxpayer's paper W-2. Then for allocated tips, these are reported in box 8. And these are the difference between the tips the employee reports to the employer and what the employer designated the employee's tips should be. Now, allocated tips aren't included in box 1, and because of the FICA taxes not being withheld from allocated tips, that's why we have a special box for them, and the taxpayer will pay those FICA taxes by using Form 4137. They'll do that when they file the tax return. So when you input the amount into box 8, it's going to automatically pull through to Form 4137, and that way the FICA taxes will be reconciled. Now in box 10, we have dependent care benefits, and these are what the employer pays on behalf of the employee. Then we have our various box 12 codes. Now these can report a variety of information, and so each code corresponds to some kind of information and then has an amount attached to it. So it will report information such as 401k retirement contributions, which is code D, or the cost of employer-sponsored health coverage, which is code DD. And so as you see in the screenshot, you select the code from the drop-down menu and then type in the amount, and you can add more rows as necessary. It is very important to pay particular attention to these codes when copying from the taxpayer's paper form of the W-2. So a lot of these codes will impact their return elsewhere, so we want to make sure we're copying every detail. Now, in box 14, we have other information that's not always clear, even to the taxpayer. There's no standard list for these codes. Like I mentioned, and employers can list any description that they choose. And these will include things like union dues, health insurance premiums deducted, non-taxable income, educational assistance payments, various types of retirement plans contributions. And there are more details in the Site Coordinator Handbook regarding which Box 14 codes might qualify for the Retirement Savings Contribution Credit. If the codes do qualify, then you will check Carry to Form 8880. Some codes in Box 14 will be indicating employer contributions, and these do not qualify for the credit. So in that case, you should check Do Not Carry to Form 8880. So also on the W-2, we have a space for state and local wages and tax withheld if applicable. These are reported in boxes 16 through 19. Now, some of these boxes do auto-populate, so again, we just want to review and correct as necessary. Now let's talk about another part of the W-2 within the tax software that's not actually on the taxpayer's paper copy of their W-2. So this is unreported tips. So if the taxpayer had unreported tips, we're going to add them to the blank of the W-2, and in TaxSlayer, if the unreported tips are greater than $20 a month, then we're just going to add them to the W-2. If they are less than $20 a month, then we're going to add them to Form 4137 and the W-2. And this is because unreported tips that are less than $20 a month are exempt from FICA tax. So when we're adding those tip amounts to Form 4137, we're actually exempting them from the FICA tax on page 2 of the 1040. Now let's talk about household employee income. If the household employee earns less than $2,000 a year, the employer is not required to issue Form W-2. However, this income is obviously going to be reported on the tax return, and it is classified as earned income on line 7. Now, our household employee income has a separate entry point in TaxSlayer, so I would advise that you reference your summary chart for very straightforward directions on how to enter this type of income. Scholarship income will also go on line 7 of the 1040, and you can normally find this on a W-2 or a 1098-T, or sometimes it will just be self-reported by the taxpayer. So scholarship, fellowship, grant income is taxable when it is used towards unqualified educational expenses. So for instance, if it's used towards room and board or general living expenses, that would be considered unqualified, so it would be taxable. And a good way to easily catch this is if the amount in box 5 of the 1098-T is greater than the amount in box 1. So essentially, if scholarships or grants are greater than qualified tuition and expense payments, then part of that will likely be taxable income for the taxpayer. Now, this next bit is something we're going to talk about more in Unit 2, but disability pension income can also pull through to line 7 of the 1040, and this is typically when a 1099-R has code 3 in box 7, and if the taxpayer is under retirement age for that particular plan. In that case, the distribution is going to be treated as wages and will pull through to line 7 of the 1040. We'll talk more about this in Unit 2, but you're going to click on the 1099-R, check here to report on Form 1040, line 7. So let's move on to line 8. This is our line for interest income, which normally is reported on Form 1099 INT. So our usual boxes are box 1 for interest income and box 3 for interest on U.S. savings bonds and treasury obligations. We also have box 2 for early withdrawal penalty box and box 4 for federal income tax withheld. So reported in boxes 1 and 3 are our interest and our interest on U.S. savings bonds, which are both classified as unearned income. Then in box 2, we have our early withdrawal penalty. So this will show the interest or principal forfeited because of an early withdrawal of savings. So for example, if a CD, if the taxpayer has not reached the time limit before withdrawals allowed, then they will incur this penalty. Now in box 8, we have tax-exempt interest, and this has a separate entry point in TaxSlayer. So you'll see in the screenshot that when we click on interest and dividends, we're given all of these boxes, and we want to check the second option, which is for tax-exempt interest income. So even though our 1099 INT might have both our interest income in box 1 and our tax-exempt interest income in box 8, we're actually going to enter these amounts on 2 separate entry screens within the tax software, which can be a bit confusing, so I want to point it out with the screenshot. Now let's look at line 9. On Form 1099 Div, we'll find dividends and distributions. In box 1A, total ordinary dividends. 1B, qualified dividends. 2A, total capital gain distributions. And 4, federal income tax withheld. So in boxes 1A and 1B, we'll have our ordinary and qualified dividends. As a reminder, a dividend is just a distribution of a portion of a company's earnings to its shareholders. So for example, if a taxpayer invests in Walmart, then they will purchase shares of Walmart stock, and then we'll have the opportunity to receive cash dividends that are paid by the corporation and are taxable. This is classified as unearned income. Now, reported in box 2A, we have capital gain distributions, and these will commonly occur when a taxpayer sells stocks or securities in a mutual fund. Capital gains are also taxable income. Now let's move on to line 10 of the 1040. On line 10, we'll find taxable state refunds, which are generally reported on Form 1099-G. And this is a form that reports certain government payments. So on this form in box 1, we'll have unemployment compensation. and we'll talk about this a little bit later. In box 2, we'll have state or local income tax refunds, credits, or offsets. And then in box 4, we have the amount for federal withholding. So, state tax refunds are taxable if the taxpayer, number 1, received a refund on their prior year state return, and number 2, itemized deductions on their prior year federal return, and number 3, deducted state income tax instead of state sales tax on their prior year federal return when itemizing. So if all of these conditions are met, then the state refund from their prior year state tax return might be partially or fully taxable. So what if a taxpayer doesn't know if they itemized deductions last year? You can ask them some leading questions like, did you have any mortgage interest, a large amount of medical expenses, charitable contributions, etc., that you listed on your return last year? Now, a taxpayer may not be sure if they did, but often they are very confident that they did not have any of these deductions listed last year, in which case they took the standard deduction. If the taxpayer meets all 3 conditions for the state refund to be taxable, but they don't have the necessary prior year information, then the whole refund will be taxable. So when we're looking at the software and TaxSlayer, we'll see at the very top of our state refund worksheet, there will be this section that says bypass state refund worksheet, and it will make the full amount of the refund taxable. But hopefully for most taxpayers, you won't need to use this bypass because they should have access to their prior year information. And so in that case, you'll start off with section 1. Now, the first blank asks for the actual amount of the state tax refund. And this will either be on the 1099-G that the taxpayer received in the mail, or the amount that you can find on their prior year state return. The next blank asks for the prior year amount of federal itemized deductions. So again, I want to reiterate, this is the amount of federal itemized deductions. And then it asks in a drop-down menu for last year's federal filing status. After that, you'll see a bunch of checkboxes to indicate whether or not the taxpayer or the spouse took the increased standard deduction. So if you'll remember, the standard deduction will be increased based on the taxpayer's age and whether or not they're blind. So if you're checking any of these boxes, then you're essentially saying the taxpayer did take the standard deduction, in which case their prior year state tax refund will not be taxable. Because remember, one of the conditions for the state tax refund to be taxable is that the taxpayer itemize deductions on their prior year federal return rather than taking the standard deduction. Now, there is a specific section for folks who filed married filings separately in the prior year. So, for section 2, you're going to enter in the amount of the state tax refund in the blank if the taxpayer filed MFS last year on their federal return. And then at the very bottom of this worksheet, we have a place where you input the prior year taxes that were deducted when the taxpayer itemized on their federal return last year. So the first blank is going to be a prior year state tax withheld that you can find on their prior year Schedule A, line 5A. And then it's going to have a place for a prior year sales tax deduction, and that will be found on their prior year Schedule A, line 5B. Now remember, the only way that a taxpayer's state tax refund from the prior year will be taxable is if the taxpayer deducted state income tax when itemizing on their federal return. So really, we're mostly concerned with this first blank. if they took state sales tax deduction on their prior year federal return, then their state tax refund will not be taxable. Let's move on now to line 11. Now, alimony is a payment to or for a spouse or former spouse under a separation or divorce instrument. And the person receiving the alimony must report it as income. Note, the person paying alimony can take that amount as an adjustment, and we'll cover this in our Unit 2 training. Now, alimony may include medical bills, housing costs, and other expenses. It does not include child support or voluntary payments outside of the divorce agreement. If you'll remember, child support will stop once the child is grown. So once the child turns 18 years old, that taxpayer will no longer receive their payments from their ex-spouse. Their child support payments, that is. In terms of the information needed to report alimony, you do need to know the exact amount from the divorce or separation agreement if it's executed after 1984. And this is important because the amount of alimony that is reported on one tax return as income must match the amount of alimony reported on the other ex-spouse's tax return as the adjustment. Now let's move on to line 12. On line 12, we have business income, and often this is reported to us on a 1099 miscellaneous. So you'll see in box 3, we have other income, which we'll talk about later on in this video. In box 4, we have the amount of federal tax withheld. But what we're focusing on here is box 7, which is non-employee compensation. And this will pull through to line 12 of our 1040. So business income that's reported in box 7 of a 1099 miscellaneous, it can go by several different names. It's listed as non-employee compensation, which is paid to an independent contractor. And then these are people who typically work for a company or organization without being considered an employee. And this includes folks like freelancers, part-time workers, contractors, and interns. Now, if payment for services from a company or organization is reported in box 7, then the taxpayer is being treated as a self-employed worker. Now, self-employment income, which is also known as business income, is taxed differently than wages or salary income. For example, what we would see on a W-2. So why is it important to designate between wages and business or self-employment income? That federal income taxes are not withheld from business income. FICA taxes are also not withheld from business income. However, the taxpayer must still pay federal income taxes and FICA taxes on their business income. They'll just do it when they actually file their tax return. So this can be reported to the taxpayer in a variety of ways. Typically, we'll see it on Form 1099 Miscellaneous in Box 7, but we can also see it on Form W-2. And in this case, Box 13, Statutory Employee, will be checked. And when that happens, you'll enter in all the W-2 information, and when you click Continue, TaxSlayer will prompt you to fill out a Schedule C. Now, within the Schedule C, you'll go into the Income section. And so as you can see here in the Income section, on that second blank, you'll actually input the income one more time. So that won't duplicate the income, but by putting it in that second place, you will pull it through to the Schedule C. So if someone has a W-2 with Box 13 statutory employee checked, you will be entering in that income twice, once on the W-2 and again on the Schedule C income section. You'll also see business or self-employment income on a 1099-K, and this is especially common with Uber drivers. And then, of course, self-employed people will have cash payments, and they'll self-report this. Having a part-time business, even in addition to another job, may still be self-employment income and will need to be reported as income even if the taxpayer doesn't receive an official tax document. So even if they have only cash payments, they'll still need to report that as business or self-employment income. So what's the difference between business income and other income? An activity will qualify as business income if the primary purpose for engaging in the activity is for profit, and the taxpayer is normally involved in the activity with continuity and regularity. Now, in contrast, other income is usually a sporadic activity or a hobby, so it doesn't qualify as a business. And then a hobby is defined as something that is undertaken for pleasure during leisure time, not for profit. Let's talk about a few terms. So first we have business expenses, and these are amounts that are ordinary and necessary to carry on the business. Business expenses are subtracted from gross receipts to obtain either the net profit or the net loss. So gross receipts minus expenses equals our net profit. Another way to say that is net profit or loss is equal to gross receipts minus expenses. Now, the cash method of accounting will report all income when received and deduct all expenses when paid. And this is in contrast to the accrual method of accounting. Inventory are the items the taxpayer buys or makes for resale to others. Depreciation is the cost of items that are expected to last more than a year and therefore should be spread over a period of years rather than deducted in the year of purchase. So now that we've talked about those terms, let's talk about the VIDA filing requirements for people with business or self-employment income. So in order for a self-employed person to file with us as a VIDA site, they have to have less than $25,000 of business expenses. And note that this is a limit on expenses, not a limit on income. They must use the cash method of accounting. They can't have any inventory. They can't want to depreciate their assets. They must report a profit, not a net loss. So we cannot file a return for taxpayers who have a net loss. And this is something that we commonly saw last year, site coordinators forgetting that this was a filing condition. And then they cannot have employees. So as a quick reminder, the Schedule CEZ is just a simplified version of the Schedule C. Now, in tax year 2016, we actually did not have access to a Schedule CEZ, but we have been told that going further, we should have access to both Schedule C and Schedule CEZ. So we're going to use the Schedule CEZ if there are few business expenses and only one business. And what I mean by few business expenses is less than $5,000. And then we're going to use Schedule C if there are a lot of business expenses or more than one business. But remember, for VITA purposes, the business expenses cannot exceed $25,000. So we're going to use Schedule C if the expenses are between $5,000 and $25,000. And again, that's just a limit on expenses, not a limit on income. Let's talk about different deductible business expenses. First, we have advertising. So these are costs associated with promoting the business through various means, including yellow pages, newspapers, magazines, billboards, racing sponsors, television spots, etc. And then we have car and truck expenses. So the more people who work for Uber and Lyft, the more we see taxpayers with these expenses at our site. And this in particular is an area that I've seen many people make mistakes, so let's talk about it in a bit of detail. A taxpayer who uses a car or truck in a business may be able to deduct the costs of operating and maintaining the vehicle. And vehicle expenses are calculated using the standard mileage rate. Now, because actual expenses are going to include depreciation, which is out of our scope, we are going to mostly use the standard mileage rate. And in most cases, using the standard mileage rate is going to be the most beneficial for our taxpayers. So when they use that rate, it's encompassing all different kinds of vehicle expenses, including depreciation. So rather than accounting for the actual expenses, that standard mileage rate will account for all of those expenses. So further, a taxpayer cannot deduct their actual expenses for maintenance or for car insurance if they're taking the standard mileage rate. And this is something that we see a lot of Uber drivers keeping very detailed records of. They'll typically have some kind of notes about how much they paid in insurance and maintenance. And we just need to inform them that if they're electing to take the standard mileage rate, that they cannot also list out their actual expenses. It's either one or the other. Then we have commissions and fees. So these are commissions paid to both individuals and businesses. And then any kind of fee that's necessary to operate the business. We have different kinds of insurance. So these are policies and coverage that are deductible for the business operation. It can include property insurance, automobile insurance, malpractice insurance. And then, like I just mentioned, they cannot deduct both their actual automobile insurance expenses and the standard mileage rate. And then health insurance is not deductible. For interest, this can be interest paid on operating loans. It does not include mortgage interest. Then we have legal and professional services. So these are fees that are paid to professionals like attorneys, accountants, appraisers, and engineers. Then we have our office expenses. So these are general things like supplies, which include pens, paper, postage, other necessary office supplies. And then we have rent or lease expenses. This is a little bit more complicated, so I would encourage you to call Save First Leadership if you encounter this at the tax site. So rental fees are for things like cars, trucks, vans, machinery or equipment, or other personal property. And then if they have a lease, it has to be 30 days or less to be in scope. Anything over 30 days will be out of scope for us. For repairs or maintenance, this can be repairs on equipment, vehicles, or office space, perhaps repairs on buildings, etc. So let's talk about supplies other than just general office supplies. The taxpayer can deduct costs for general operating supplies not associated with cost of goods sold. So, as we said earlier, remember, business and self-employment income involving inventory is out of scope. So if the taxpayer has anything related to cost of goods sold, that will be indicative of inventory and will therefore be out of the scope of VITA. The taxpayer can also deduct taxes and licenses. So any fees paid in the operation of the business, such as state and local sales taxes imposed on the taxpayer as the seller of services, real estate and personal property taxes, and certain licenses and regulatory fees. Now, while the taxpayer is away from home for business, they can deduct expenses related to travel, meals, and entertainment. These, of course, have to be ordinary and necessary expenses, and there are certain requirements for these to be deducted, so I would recommend that you call Save First Leadership if the taxpayer is wanting to deduct these expenses. In order to deduct utilities, these have to be normal electric, gas, water, and telephone bills. They cannot be for personal expenses, only business-related expenses. So let's circle back to business mileage rates. If used for business purposes, the taxpayer can receive a mileage deduction at the federal rate. The taxpayer cannot deduct commuting miles. So if you need to revisit the definition of commuting miles and the definition of business miles, please consult the Pub 4012. Now, the taxpayer cannot calculate depreciation. That is out of scope for VITA. So while the federal mileage rates do account for depreciation, the taxpayer does not have the option to calculate actual depreciation on their return. In general, with business expenses, I would recommend either consulting Schedule C instructions or calling Save First Leadership just to double check that all business expenses we're inputting into the tax software are qualified business expenses. Let's move on now to line 19. Now, on our 1099-G in box 1, we'll find unemployment compensation. And oftentimes there will be an amount in box 4 for federal income tax withheld. There's nothing particularly tricky about unemployment compensation, but I will mention that sometimes there are repayments of unemployment compensation, in which case I would call Save First Leadership. Let's look at line 20 now. So this will include Social Security benefits on Form SSA 1099. In box 5, we have net benefits, which is box 3 minus box 4. And then in our lower left-hand corner, we have a description of the amount in box 3. This is where we'll find more details such as Medicare premiums that are being deducted, as well as the total additions. And then in box 6, we have any voluntary withholding on these benefits. So like I mentioned, in box 5, we have our net benefits. And these Social Security benefits will include monthly retirement, survivor, and disability benefits. As y'all know, Social Security benefits are different from SSI, which is Supplemental Security Income. And SSI is really aimed at helping low income, elderly, blind, and disabled individuals pay for basic needs. So, Social Security benefits, of course, are classified as unearned income. Generally, if these benefits are the only source of income to the taxpayer, then they are not taxable. This is going to be dependent upon filing status and other reportable income. So, if the taxpayer has other sources of income, then Social Security benefits will likely be partially or fully taxable. So, let's talk about Medicare premiums that are reported in Box 3. Many taxpayers will have Medicare insurance premiums, which is Part B, or Medicare prescription drug premiums, which are Part D, deducted from their benefits. And if the taxpayer has more than one Medicare part deducted, then in the software we'll add those amounts together and enter them on one line. So you can see in the screenshot here, we would enter all Medicare parts in that one blank. Sometimes the description of the amount in Box 3 will indicate that the taxpayer has received lump sum benefit payments. And essentially, all that means is that the taxpayer has received Social Security benefits for the current year and for prior years. And in order to optimize the taxability of these benefits, it might be more beneficial for the taxpayer to use the lump sum worksheet. Now, there are more details in the Pub 4012 that you can consult, but I would recommend calling Save First Leadership if the taxpayer's SSA 1099 indicates anything about lump sum benefits. Let's move on to line 21 of the 1040. One thing that we might see on line 21 would be gambling winnings, and these often come on Form W2G. So in Box 1, we see the gross winnings. Box 2, the date that those were won. Box 3, the type of wager. And Box 4, any withholding. Now, we might also have some state information on the W2G, so make sure to enter that into the tax software as well. And then for more details on how your state addresses gambling winnings, please see your state return video. But a taxpayer can receive one or more Form W2Gs reporting these winnings. This, of course, is classified as unearned income. And if the taxpayer has gambling winnings that are not on an official tax document, they still need to report that income on their tax return. Now, another thing that we might see on line 21 is jury duty pay. And this must be reported as taxable income. It is classified as unearned income. Then, like we had mentioned before, the 1099 miscellaneous can report other income in Box 3, and this would pull through to line 21. Now, there might be an amount of withholding in Box 4, and we want to contrast Box 3 with Box 7, which is non-employee compensation. Now, Box 7 income is going to pull through to line 12 of the 1040, which is business and self-employment income. So our amount in Box 3, other income, is what will pull through to line 21. So what exactly is other income? It's going to be reported in Box 3 of the 1099 miscellaneous and will generally include things like prizes, awards, taxable damages from a lawsuit settlement, and other taxable income. And all of these are classified as unearned income. So there might be a chance that the taxpayer's 1099 miscellaneous was issued incorrectly. When a taxpayer comes in with a 1099 miscellaneous and there is an amount in Box 3, we want to clarify with the taxpayer what that amount is actually for. mainly to ensure that it isn't non-employee compensation that should be reported in box 7 and therefore carry to line 12. So just clarify with the taxpayer what the income is for, and it might be that their employer or the person who issued them the tax document had put the amount in the wrong box on the form. We see that fairly frequently. Now let's talk about the standard deduction. But first, let's recap where we are in the flow of the 1040. So we have our adjusted gross income, and from there, we're going to take the standard deduction, or we're going to itemize deductions. We're also going to subtract out personal and dependency exemptions, and that will leave us with taxable income. So let's look at line 40, which includes the standard deduction as well as itemized deductions. So the standard deduction will reduce the amount of income that is taxed. And the amount of the deduction is based on filing status, age, whether the taxpayer or spouse is blind, and whether the taxpayer is a dependent. Now that is calculated automatically in TaxSlayer, but you can reference the Pub 4012 just to check that the amount is pulling through correctly. So again, this will be in the Deductions tab in Exhibit 1. There's going to be the standard deduction for most people, and then after that, we'll see charts for the standard deduction that is increased based on the taxpayer's age and whether or not they're blind. Let's move on now to non-refundable credits. Non-refundable tax credits will reduce the tax liability, but only to 0 and no further. In particular, we're going to talk about the Child and Dependent Care Expenses Credit, Child Tax Credit, and Retirement Savings Contribution Credit. So you can look at the Pub 4012 at the Non-Refundable Credits tab for more details, and you're going to use this to help you figure out whether or not a taxpayer will qualify for any of these non-refundable credits. So let's first talk about line 49. This is the Child and Dependent Care Expenses Credit. It's non-refundable, and it's applied to offset expenses that are paid so the taxpayer can work or look for work. It's for a dependent who is under 13, or a spouse who is incapable of self-care, or any dependent who is incapable of self-care. So let's discuss a few eligibility requirements. The care has to have been for a qualifying person, which we just mentioned before. So the taxpayer and spouse have to have earned income, and there are some exceptions to this. So a spouse is treated as having earned income for any month that that spouse is physically or mentally incapable of care or is a full-time student. Now the expenses must have been, again, for work or to look for work. And payments can't have been made to the taxpayer's spouse, dependent child, or any child who's under the age of 19. The taxpayer must have the care provider's name, address, social security number, or their EIN if they're paying a daycare. Now, tax law only requires that the taxpayer does their due diligence to acquire this information. If the taxpayer cannot secure this information, there is still a way to claim the credit. It's just a little bit more of a process. But if the taxpayer doesn't have the information, feel free to call Save First Leadership and they can lead you through the process of what to do without the info. So what are qualified work-related expenses? The expenses must be made for the care of the qualifying person to allow the taxpayer and spouse to work or look for work. So we keep repeating that because it is very important that the care is for that purpose. And this includes the cost of services for the qualifying person's well-being and their protection. Now, expenses to attend kindergarten or a higher grade are not a qualified expense. Expenses for summer camp do qualify if it's day camp, but those for overnight camp do not qualify. And then there are limits to the amount of expenses. So there's a $3,000 limit for one qualifying person, or a $6,000 limit for two or more qualifying persons. Now, if you had expenses that met the requirements for the previous tax year, except that you did not pay them until the current tax year, you may be able to claim those on your tax return for this year. And like I mentioned, taxpayers who cannot provide all of their providers' information or who have incorrect information, they may still be able to take the credit if they can show that they used due diligence in trying to obtain the information. So if you'll remember back when we were talking about the W-2, in box 10 of the W-2, it might indicate that the taxpayer's employer had provided them some kind of dependent care benefits. And if that is the case, these benefits are something that the employer paid on the taxpayer's behalf. And so the taxpayer can't count this money towards the credit. The amount will actually reduce the dollar amount of the credit for the taxpayer. So again, it's reported in box 10. And these are something that the employer pays for on behalf of the employee. Again, reducing the dollar amount of the credit for the taxpayer. Now, for divorced and separated parents, the custodial parent can claim the child and dependent care expenses credit even if they did not claim the dependency exemption. Let's look at a few examples. Julie spent the following amounts on child care for her 10-year-old daughter, Melissa. Are any of these eligible costs for the child and dependent care expenses credit? $300 for overnight camp, $1,000 to her ex-husband for after-school care, $1,500 to her mother for after-school care, $500 to her 15-year-old son for babysitting. So $300 for overnight camp will not qualify, only day camp does. $1,000 to the ex-husband for after-school care will not qualify because you cannot pay an ex-spouse. $1,500 to her mother for after-school care will qualify. And then $500 to her 15-year-old son for babysitting will not qualify because you cannot pay a dependent and you also cannot pay anyone under the age of 19. Now let's look at line 51. This is the retirement savings contribution credit. Let's talk about general eligibility requirements. So the taxpayer has to have made a contribution to an IRA or other qualified plan for the tax year. There are AGI limitations, and these are going to vary based on filing status. The taxpayer has to be 18 or older, cannot be claimed as a dependent on someone else's tax return, and cannot be a full-time student during the tax year. So you'll remember in box 12 of the W-2, there's an opportunity for some codes to indicate contributions to a retirement account. Now there are certain codes that will automatically pull through to the retirement savings contribution credit. And if box 13 indicates that a taxpayer has contributed to a retirement plan, then the taxpayer might also qualify for the credit. Now for box 14, we would have to ask some clarifying questions in order to figure out if any of those codes qualify the taxpayer for the credit. But there is potential for that to be the case. So how do I know if the taxpayer has made a qualifying contribution? If on Form W-2 in box 12 you see one of the following codes. D, E, F, G, H, S, AA, or BB. And then if box 14 has codes Q or E for military personnel. And I want to caution you about certain entries in box 14 that are treated as employer contributions. We mentioned this before, but they are not eligible for the credit, and there's a lot more detailed information in your site coordinator handbook about this. So some retirement distributions will actually reduce the eligible contributions for this credit, and that will take place on Form 8880. In addition to retirement distributions that are made during the current year, the taxpayer must also reduce eligible contributions for distributions that were taken in the 2 prior years. So, if the taxpayer has a retirement distribution in the current year, they should be receiving a Form 1099-R. But in order to account for any distributions they might have received in the 2 prior years, you need to manually input those distributions directly onto the form. So you'll have to ask the taxpayer about whether or not they had any distributions in the 2 prior years. So let's look at an example. Bob, age 48, contributed $600 to an IRA during the tax year. During the year, he worked full-time and had an AGI of $24,000. He is not a student. Is Bob eligible to claim the retirement savings contribution credit? So we can look at our Pub 4012 to make sure that based on his filing status, he is below the AGI limitations, and the software will automatically consider that. We know that he's not a full-time student. He did contribute to a qualified IRA, so it's looking like he'll qualify. And yes, Bob contributed to an IRA, meets the age and AGI limits, is not a dependent and not a full-time student, so he will qualify for this credit. Now let's move on to line 52. And this is the child tax credit. The taxpayer will get 1 credit for each qualifying child under 17 years of age. And that taxpayer can claim a child tax credit for a child only if they can and do claim a dependency exemption for the child. It's a non-refundable tax credit with a max of $1,000 per child, and the amount claimed will actually depend on the taxpayer's tax liability, their modified adjusted gross income, and their filing status. And for our taxpayers, modified adjusted gross income is typically the same as adjusted gross income. So this credit is intended to reduce the tax liability owed by the taxpayer, and therefore this part of the credit is non-refundable. However, the taxpayer may be able to take the additional child tax credit, which is refundable. So now let's start talking about refundable credits. These will reduce the tax liability to 0, and the taxpayer will receive the remainder of the credit value as a refund. So this includes the additional child tax credit and the earned income credit. Now on line 66, we have the earned income credit. As you know, this is a refundable tax credit for low to moderate income workers to encourage work, offset payroll and income taxes, and help meet basic needs. So when determining the earned income credit, we can go to the EIC tab in our Pub 4012. And of course, we can use this to see if the taxpayer qualifies, or maybe if we notice in the tax software that EIC is not pulling through, we can figure out why the taxpayer won't qualify based on general eligibility requirements. So let's talk about those requirements. So we have rules that are for everyone, and these rules are that you must have earned income, and there are some AGI limits to this. Then you must have a valid social security number and be a U.S. citizen or resident alien. You must not be filing as married filing separately, cannot have foreign earned income, cannot have investment income of more than $3,400, and the taxpayer cannot be the qualifying child of another person. And then we have rules for taxpayers who do not have a qualifying child. So these are in addition to the rules for everyone. So they cannot be claimed as a dependent by another person. They must be at least 25 but under 65 on December 31st of the tax year. And they must have lived in the United States for more than half the year. Now we have the eligibility requirements for a taxpayer who has a qualifying child. And again, these are in addition to the rules for everyone. So the qualifying child must have a valid Social Security number that allows him or her to work. They must meet the relationship test. So the child must be the taxpayer's son, daughter, stepchild, eligible foster child, or brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of them. And then the child must meet the age test. So they must be under 19 at the end of the tax year, or under age 24 and a full-time student, or any age and permanently and totally disabled. Child must also meet the joint return test. So they must not have filed a joint return for the tax year unless the child only filed a joint return with their spouse to claim a refund. They must meet the residency test, so they must have lived with the taxpayer for more than half the year. And they must not be the qualifying child of another person. So just because a person qualifies as the dependent of a taxpayer does not mean they automatically make the taxpayer eligible for the EIC. In general, the child in question must meet the age, relationship, residency, and joint returns tests to qualify. So therefore, qualifying children always meet these requirements, and qualifying relatives do not. So what if the qualifying child is a qualifying child of more than one person? If a child meets all the tests to be claimed by more than one taxpayer for the EIC, the child cannot be used by more than one person. And so for determining who claims the child for EIC, we use the same rules as determining who claims the child as a dependent. Now let's talk about disallowance of the earned income credit. The earned income credit can be disallowed for reckless or intentional disregard of the rules, which causes a 2-year disallowance, or a fraudulent claim, which causes a 10-year disallowance. In order for the taxpayer to reclaim the EIC again, they must wait the full period of disallowance, and then after that, submit Form 8862 with their tax return, and that will allow them to start claiming EIC again. But let's look at some examples. We have Sharon, who has earned income and AGI of $15,525. She takes care of her sister's son, Eric. If Eric is 12 years old and began living with Sharon in August, can Sharon claim EIC? So first we're going to see if Eric is a qualifying child for EIC. And we can tell right off the bat he's not going to be a qualifying child because he began living with Sharon in August, meaning he did not live with her for more than half a year. So now we need to see if Sharon qualifies for EIC without a qualifying child. And Sharon actually won't because her AGI is too high to claim the EIC alone. And because Eric did not live with her for more than half the year, he's not her qualifying child. Now, Doug and Donna are married and live together with their 4-year-old son, Sam. Their combined earned income is $25,000, but they file separately. Doug reports an AGI of $11,000 on his return, and Donna reports an AGI of $14,000 on her return. Can Doug or Donna claim the EIC? So we know they cannot claim EIC, and that's because they are filing separately. So just another reason that the MFS filing status is not advantageous. It automatically disqualifies them from the credit. Then we have Tom, who's 64 years old, retired, and collected $10,000 of Social Security during the tax year. He does not have any qualifying children. Can he claim EIC on his return? So Tom cannot, because he does not have any earned income. We know that Social Security benefits are considered unearned income. Let's move on to line 67. This is for the additional child tax credit. So like we mentioned, the child tax credit is intended to reduce the tax liability owed by the taxpayer. Therefore, that part of the credit is just non-refundable. But taxpayers may be able to take the additional child tax credit, which is refundable. And it's a refundable credit with a max of $1,000 per child. The amount claimed depends upon meeting general eligibility requirements, as well as how much of the non-refundable child tax credit is claimed. So the taxpayer cannot claim more than $1,000 of CTC and ACTC combined for one child. They must meet all the requirements of the child tax credit, which means the child has to be under 17, a U.S. citizen, dependent of the taxpayer, meet one of the qualifying relationships, not provide over half their own support, and live with the taxpayer for more than half the year. Then the taxpayer must have $3,000 of taxable earned income. Now there is an exception to this, and that is for taxpayers with 3 or more children. They may be eligible regardless of their income. Let's move on now to refund and amount of tax owed. So when we get to line 75 and line 78, we're going to see whether or not the taxpayer is due a refund or if they owe the IRS more money. Taxpayers can choose to receive their refund either by check or direct deposit. And check takes about 6 to 8 weeks to be mailed. Electronic deposits will be made within 1 to 2 weeks, so we highly encourage taxpayers to decide on taking a direct deposit if they have a bank account. Taxpayers can also choose to allocate part of their refund to order savings bonds in $50 increments. Now, if the taxpayer has tax due instead of a refund, then we advise the taxpayer to file their return on time, even if they can't pay the full amount owed. They should pay as much as possible by the due date to reduce any penalties or interest. And then once the taxpayer receives a notice, they can pay the remaining amount in full or choose another payment option if needed. So, some payment options that we don't really see much at the tax site because they're done off-site, but we can still inform the taxpayer of, are the ability to pay with credit or debit card. Unfortunately, this option does incur a convenience fee though. The taxpayer can also enroll in the ePay system. So this is the electronic federal tax payment system, and it allows them to pay online on irs.gov. They can also do IRS Direct Pay, which is a free one-time payment system offered through irs.gov. But what if the taxpayer cannot pay? So they should try to pay in full within 120 days, because if they can avoid paying a fee to set up an installment agreement. If not, they can apply for an online payment agreement, and this will be called an OPA. They can go to irs.gov and search online payment agreement. Taxpayers who can show that they have substantial financial difficulty if they pay their tax on the due date are considered to have undue hardship. And they can request an extension by filing Form 1127. Unfortunately, this is out of scope for us, but we can advise them to visit or call the local IRS office. Keep in mind that undue hardship is more than inconvenience. Now let's talk about estimated tax penalties. This is out of scope for VITA, but I want you to be aware of it. It's calculated on Form 2210 and reported in the Amount You Owe section on the Form 1040. And this happens if the taxpayers must make estimated tax payments if they expect to owe at least $1,000, and their withholding and credits will be less than the smaller of 90% of the tax shown on the current return and 100% of tax shown on the prior year return. Now let's talk about the state return. So rather than going through each state return here, I would rather you go through the full length video. So again, if you'll go to the core training website and you click the drop down by Unit 1, you can scroll all the way down to Day 4, where you'll find your state's return video. And you also have a few resources available to you. So if you go back to the resources under the Save First binder, you'll see all the state's Pub 4012s. Before we start our TaxSlayer exercise, I'm going to be following your returning staff helpful tips document to show you some specific TaxSlayer entries. So we're going to create a sample return. And for this example, we'll say the taxpayer is divorced and so they're single. Now, the first thing that I want to point out are these checkboxes below the taxpayer information, specifically the second checkbox. TaxSlayer is asking whether or not the taxpayer is a full-time student. So incorrectly checking this box, if the taxpayer is only a half-time student, will disqualify the taxpayer for the retirement savings contribution credit. So just be extra careful about that. And that also applies if there were a spouse. So because I entered in an Alabama address, it's automatically pulling up Alabama state questions. This might happen for your state as well. We'll just quickly answer these so we can proceed. Now, the next thing I want to point out is for dependents. TaxSlayer will grant dependency to almost any person that you input in this section. So, of course, always use the Pub 4012 to determine dependency exemptions prior to entering into TaxSlayer. So let's say this taxpayer is divorced, and let's talk about the different benefits and their allocation to the custodial parent and the non-custodial parent. So let's first talk as if this sample taxpayer is the custodial parent. And let's say they have released the dependency exemption to the non-custodial parent by signing Form 8332. So even though they've released the dependency exemption, we're still going to input the child here. And that's because the taxpayer might still qualify for head of household, earned income credit, or child independent care credit. So if they've released the dependency exemption, we want to check this box that says, check if this child is not your dependent. And that way they still might pull through for EIC and child independent care credit. Now let's talk about if this taxpayer were the non-custodial parent. So in that case, the only way that they're entitled to the dependency exemption is if the custodial parent has signed an 8332 and the non-custodial parent files that 8332 with their return. Now in this case, you're going to input the dependent's information just like you would in our other scenario. But in this case, this non-custodial parent is only allowed to claim the dependency exemption and the child tax credit. So for this scenario, we have to click check if you wish not to claim this dependent for the earned income credit. Now, one note, if the child lives with the non-custodial parent for 0 months out of the year, TaxSlayer will automatically give a warning saying that the non-custodial parent has to file an 8332. So here we see our warning. It says you must have a signed Form 8332 or a post-1984 divorce decree. Let's move on to the federal section. And let's go to our W-2. So one thing I want to remind you, there is a space for unreported tips. So any tips that the taxpayer self-reports that did not appear on their official tax document will go in this blank. Now, if unreported tips are less than $20 a month, we must also enter those on the 4137. So to do that, we're going to go to our form search bar. And we're going to put any tips less than $20 in a calendar month on this blank. And that is so that we're exempting them from FICA tax. Now, if they're over than $20 a month, we would not add them to this blank. We would only add them on the W-2. Let's look at household employee income. So it has a separate entry point, and it's actually going to be in other income, other compensation, household employee income. And if you ever forget how to input this kind of income, just refer to your summary chart. This should always pull through to line 7 of the 1040. Okay, let's go to our state and local refunds. So at the top, we have a way to bypass this worksheet, and this is if the taxpayer does not have access to their prior year information, which means the full state refund would be taxable. But for most taxpayers, hopefully we can just go to Section 2 and fill out all the information from our prior year state refund, and then our federal itemized deductions, and our federal filing status from the prior year. Now, remember, we won't be checking any of these checkboxes because doing so means the taxpayer took the standard deduction and did not itemize in the prior year, which means their state refund would be non-taxable. Section 2 is for taxpayers who filed married filings separately in the prior year. At the bottom of the page, you have to enter in the information from the prior year's Schedule A, either line 5A, state income tax withheld, or line 5B for state sales tax deduction, whichever the taxpayer took. Now let's look at our Form 1099 miscellaneous. If a taxpayer has a 1099 miscellaneous with an amount in box 7, once we enter that amount and click continue, we always want to add that income to a Schedule C or a Schedule C Easy. Non-employee compensation will always be attached to a Schedule C or Schedule C Easy. Let's go to our credits. And let's look at the Child and Dependent Care Credit. Now, as a reminder, for the Child and Dependent Care Credit, you actually have to enter in some information twice. First, you're going to enter in the child care provider, whether that's a person or a daycare, and then you're going to actually apply those expenses to a particular dependent. So in this case, we would enter the child care information and say it's $4,000. Then we would apply those expenses to the dependent. And so you should have a difference of 0 at the top. Now let's talk about our retirement savings credit. So most of this credit is going to happen automatically, and that's because contributions that are on a W-2 in box 12 will automatically pull through to the credit. And then any distributions on a Form 1099-R will automatically pull through to reduce a credit. The only thing that we need to worry about are any prior year distributions that the taxpayer might have had. And because they wouldn't have a tax document in the current year for those prior year distributions, we would have to enter those in manually on our Form 8880. And that's what you're seeing right here. So we would need to enter in any distributions from prior years here. Let's go ahead and take a look at our Don Draper exercise. I would pause the video right here and go ahead and read through the interview notes as well as the intake and interview form before we get started in TaxSlayer. So I'm going to start a new return. Remember not to start the Social Security number with the number 9. And so if we read our interview notes, we see Don and Betty did not live together during the last 6 months of the tax year. So Don might be able to file as head of household since he's considered unmarried. Sally, Bobby, and Jean do not live with Don, so they're not going to qualify his dependents. But Jack lives with Don for more than half of the year, and so will qualify as Don's qualifying child, which makes Don eligible for married head of household. So I'm just going to take the information from Don's intake and interview form. And now, even though Don lists his wife's information, we don't need to enter it because he is filing as head of household. You can enter the zip code of wherever you live. And so because I put an Alabama address, it's going to ask us questions about the Alabama return. Yours might ask you about your respective state. I'm going to go ahead and enter in this information for Alabama. So it looks like Jack qualifies as Don's dependent. He's totally and permanently disabled. During tax year 2016, which is the software we're in right now, Jack is turning 22. He is a full-time student, and he is totally and permanently disabled. Now we're going to move to our income section. So under wages and salaries, we see Don's W-2. It's from Sterling Cooper. So note when we enter box 1, everything auto-populates. We need to double check and make sure all those numbers are correct and add our withholding. Everything looks correct though. So we're going to go down and enter the state information. I'm going to select Alabama. And enter in the amount of withholding. And click continue. And then next we have an interest statement. So I'm going to click interest or dividend income. And then click interest income. Continue. This is from Federal Credit Union. In box 1 we have $140. Box 2 we have $18. And then in box 6 we have foreign tax paid, which we'll talk about more in unit 3. We'll go ahead and enter that. Next we have our taxable state refunds. So let's go ahead and go to the worksheet. It says Don and Betty itemized deductions last year and they received a $190 state refund. Their total itemized deductions were $14,220, and last year they filed as married filing jointly. And the amount from their prior year Schedule A, line 5A, is $1,650. Now we have Don's business and self-employment income. So because he did not receive a Form 1099 miscellaneous, and he just had cash income, we don't need to click Form 1099 miss. We can just start directly on the Schedule C. And he doesn't have a separate business, so we're going to skip this section and leave it blank and go directly to the code, which we have available. And we're going to go ahead and add the cash income in the income section. We're going to add it to the gross receipts line. Make sure that you don't enter cash income on this other income line. It should always go on the gross receipts line. So we have some expenses, so we'll click General Expenses. He had $300 for supplies. And then he has some car expenses. I'm going to go to car and truck expenses. And he drove 64 business miles every month. So we're going to do 64 times 12 to get 768 business miles. And he bought the car and started using it for business on January 1st, 2006. He had another car for personal use. And then he has evidence and it is written. So in this instance, he used the car only for this business use. He used his other car for personal use. So he did not use this vehicle during off-duty hours. In that case, we don't need to enter in any commuting miles. Okay, let's click continue. So next we'll see Social Security benefits. It says Don's son Jack was totally and permanently disabled, so he received an SSA 1099. And when Don came into the tax site and filled out his intake interview form, he checked that he had Social Security benefits because he brought his son's tax document. But as you know, we never enter in the child's income onto the parent's tax return, so we don't need to even enter in any of this information. So let's go on to other income. It says Don won $400 in the state lottery, and he didn't receive a form for this. So we're going to go to other income not reported elsewhere, and write lottery 400. This will be carried to line 21. Then we have some notes, so we're going to take a look at our summary print page and just check these notes. So because Don has some self-employment income, an adjustment for part of self-employment tax will already pull through, but we'll talk about this more in Unit 2. And then if we go to page 2 of the 1040, we'll see that self-employment tax is automatically pulling through in the other taxes section. So at this point, we're not going to go through the e-file section because we haven't completed our health insurance section yet. So we'll hold off on that until we get to Unit 2.